What causes recessions? Are we in one? And where is the US economy headed? In part one, we cracked open the causes of recessions, from yield curves to consumer spending to oil. But here's the thing: the economic playbook changed in the early 2000s. Massive, monumental shifts started to reshape the US economy into what it is today. And the old rules, they don't apply anymore. In this video, we're diving into what's different now, why it matters, and my silent depression thesis. Are we in a hidden economic slump? Let's find out. So, in part one, just very, very briefly to recap, remember the US economy, the financial system is leveraged. It is a levered system. The monetary base is only 5.6 trillion, yet M2 money supply is 4x that. And M2 is not even anywhere close to the most broad way to measure the number of dollars in the system. So we have a levered system. Where is some of this leverage coming from? It's coming from private banks. And so remember, the way a bank works, the way it makes money is they borrow at short-term durations and they lend into long-term durations. And the reason for this is that generally speaking, you can get a higher interest rate by doing that, right? You make a profit. The difference between these two is your profit. So this white line, anytime is above the dotted line, that is basically showing if the bank were to borrow at 1 year, and then send a 10-year, long-term loan out, they would be able to capture whatever that interest rate is. So sometimes it's as high as 3%, right? Meaning the interest rate they are charging is 3% higher than the interest rate that they paid for the money that they used to extend the loan. So we can see that total loans and leases by private banks. This is one of the areas where leverage, right, where dollars are coming from. Even though the monetary base is only 5.6 trillion, private banks actually get to print money. A lot of people don't know this, but the vast majority of the dollars in the system were just created by a private bank. When they write a loan, when they write a mortgage, they are just creating dollars out of thin air. And we can see total loans and leases divided by M2 money supply. And what we saw is that for many, many decades, private bank credit drove things. It drove spending. It drove credit extension. And the private banks were the ones doing that. And so we can see that total loans and leases by private banks actually outpaced the M2 money supply. Well, something happened in 2008. We established inverted yield curves, cause that strategy to become unprofitable, right? Banks start to pull back on lending. As soon as the yield curve inverts, private banks stop issuing credit or loans, and therefore economic activity slows, right? People don't buy the house, they don't buy the car, et cetera, et cetera. Well, something happened in 2008. Total loans and leases just radically fell off. Put another way, M2 money supply started to increase way quicker than private bank credit. Here's another way to kind of think about this. This is the financial sector, all the stocks, right? JP Morgan, Chase, and Wells Fargo, and US Bank, and Citibank. This is the financial sector divided by the S&P 500. We can see that 2008 was brutal for the financial sector. They stepped away, and they have been in a downtrend relative to the S&P 500 since 2008. 2008 was brutal, but then even since then, they have been in a downtrend. So yet another way to kind of visualize this: financial conditions index. This measures the tightness or the looseness of money in the financial system. When the red line goes up, conditions are getting tighter. And when the red line goes down, conditions are getting easier. More money is likely to be, extended into the economy. And what we can see again, total loans and leases by private banks divided by M2 peaks out before the recession, and it coincides with a peak in the tightness of financial conditions, which makes sense because the yield curve is inverted, right? So it is not profitable for the bank to borrow short and lend long. It is no longer possible or profitable for them to do that. They stop doing that. Financial conditions tighten. That is why we see this correlation where the peak in the tightness of financial conditions corresponds to total loans and leases kind of slowing off. So something has to fill the void. We will get into a lot of very interesting looking charts, but this one is kind of a primer. So one of the kind of main ways to think about this, total loans and leases, like we established, drove the US economy. During the time and eras where, the U.S. economy was very strong, private bank credit creation drove things, and it outpaced M2. Well, we can see debt to GDP here in red. Just as a point of reference, economists widely believe 60 to 65, 70%, somewhere around there, totally reasonable in terms of debt to GDP. And we can see that, for the modern era from the 60s onward, debt to GDP was relatively moderate from 30 to 60%. Well, then, we established the private banks somewhat due to we increased regulations following 2008 to try to rein in the kind of insanity that was going on that caused 2008. Well, some of those regulations did hurt the banks and make it either unprofitable or very difficult to extend private bank credit. For whatever the reason is, regulation was some of it. They stepped away, right? And so something had to fill the void. Well, what filled the void was from 2007, right before the GFC, we took our debt to GDP from 63% to 121%. In a matter of just 20 years, we doubled our debt to GDP. We went right through the kind of ceiling of 90 to 100%, which is kind of danger zone. If you would ask most economists, they say that's when things start to get a little concerning, is kind of 90 to 100. Well, we went right through that. We went straight to 120%. So this is one of the ways that gap was filled. Okay. Here's another way to think about this. So generally speaking, kind of the whole theory of Keynesian economics is that in a recession, in an economic slowdown, the government can run a deficit. They can increase the deficit, run a bigger deficit. And by doing that, stimulate economic activity, get us out of the economic slowdown. And sure enough, we can see that unemployment rate, right, which is basically recessions, right, that we're looking at with unemployment rate, these peaks in the unemployment rate represent recessions. And we can see the deficit increased as a share of GDP. In fact, this is very, very tight correlation here. And this is the way it was supposed to work was, you're in a recession, your unemployment rate is spiking. Okay, well, run a large deficit. That'll kind of stimulate your economy and stimulate out of the recession. Then you bring your deficit back in. Well, that's not what's happened. So we can see we are running an utterly insane 6% deficit as a share of GDP. And in fact, this has never been seen except when the entire global economy was shut down in 2020, or the entire global economy was cracking and about to implode in 2008 GFC. Those are the only two times we have seen in modern history a deficit of 6% of GDP. Again, for a point of reference, 3% is kind of the accepted healthy amount that a reserve currency issuer, that would be the healthy amount, is about 2.5%, 3%, depending on who you talk to. Well, we are double that, and everything's great. Unemployment rate is relatively low. We're not in a world war. The global economy is not at a screeching halt, right? What we saw is that after 2020, we ran an utterly insane 15% deficit. Now, some degree of that made sense because of what was going on. The problem is that over the past 5 years, we have not really brought it back to where it should be, which is in this 2 to 3% range. In fact, it's double or triple that at 6% and seems to be only headed higher. So you can see that, following 2008, we started running kind of larger deficits. You can see that the white line here for 2008, when the deficit improved following 2008, it only came down to about 3%. And then it went straight higher all the way to 15%. And when we came out of 2020, it came only down to 6%. So we are in an uptrend, I guess you could say, in terms of the deficit as a share of GDP. This is one of the ways that you kind of step in to fill the gap of that of the private bank credit creation kind of stepping away. And here's just yet another way to think about this. Here I took the deficit and divided it by the unemployment rate. So it's just another way to visualize what we were just looking at. And you can see that this really kind of took off after 2008, which I will mark here. The number here is not really important. You're taking an unemployment rate and a fiscal deficit number, a dollar number. The point here is the direction of the line and the degree to which that line is moving. That shows you how detached from the move. That shows you how much the deficit is moving relative to the unemployment rate. So what we see is that since 2008, the deficit has just been way larger than the unemployment rate would indicate that it should be. Here's another way to fill in the gap. So here's the S&P 500 divided by GDP. And again, this I don't have access to the market cap or the value of the S&P, so we're just taking the index divided by GDP. The point here is the line and the direction of it, and the direction of travel, where it is relative to historical averages, that sort of thing. And what we can see is that after 2008, the S&P 500 just started ripping higher. So financial assets, right, like the S&P 500 is a good proxy for the kind of financialization or the financial sector of the US economy. We can see that it just wildly outperformed GDP. Because remember, in these relative charts, when the line goes up, that means the numerator is growing faster than the denominator. Not only is the S&P 500 growing the rate of increase faster than GDP, faster than the overall economy, but it's doing it much faster than the overall economy. This is called the Buffett indicator, by the way, stock market cap to GDP. And it reached a peak of, I think, 200% last year towards the end of 2024, which was a record never seen before. So here's real GDP. This is a logarithmic chart. Logarithmic charts, when you're talking about something like GDP or M2 money supply or total debt, those sorts of things, really, if you're trying to evaluate the trend, you need to look at it in logarithmic form because the system is exponential. So you got to adjust for that. Otherwise you just get a kind of parabola looking thing. So here is the real GDP in logarithmic form. And this goes from 1950 all the way through to 2006. And we can see this trend line that I put there in red. It might not be the perfect best fit line. I'm not a statistician, but we can see that that is a pretty good approximation for the trend line of growth for real GDP. Well, here's 2008, and we can see we had a temporary dip, right? But overall, we have never caught back up. In fact, if we, keeping the pace of what we had before from 1950 up until 2008, real GDP would be something like 32 trillion. Right now, it's only 23 trillion. So real GDP. So the difference here between what the trend rate indicates we should be at versus where we actually are, this is what started my silent depression thesis. Here we see that same exact concept, right? Except this time we're taking personal income in logarithmic form. Again, drawing a trend line. I did my best to make it the best fit. It's not, precise to the penny, but it's pretty close, we can see. And again, you're taking the difference because something happened in 2008. Personal income is exactly what it sounds like. This is the amount of money that all the kind of workers, individuals in the economy make in a year. And what we see is that the difference between what the trend rate indicates the personal income should be, if we were following the pre-2008 trend line, personal income should be $10 trillion higher if we had kept that rate. And in fact, right now, personal income is about 25 trillion. Well, it should be about 35 trillion. And that this gap, again, is kind of what started me on the silent depression thesis. That works out to $58,000 per year per worker in the labor force. Just think about that for a second. If we had kept the same rate of growth of kind of the overall economy, we will get into some other charts here in a second, but if we had kept that same rate of growth that we had from 1950 up until the GFC, personal income would be $10 trillion a year higher, and that represents $58,000 per year per worker. So The S&P 500, I had mentioned in the prior video in part one, the hyperfinancialization, and we'll start to kind of look at that. Okay. So we established that debt to GDP and kind of government deficits were one of the areas that we came in, that kind of came in to fill the gap of, the old way not working, right? The private banks stepping away, the old system that had run in America for decades upon decades stopped kind of working in 2008, right? We established government debt and huge deficits. That was one area that came in to fill the gap. Well, the other area we were talking about, debt to GDP, or excuse me, S&P 500 relative to GDP. This also came in to kind of fill the gap, right? Financial assets. That this is kind of the definition of financialization, where your economy becomes dependent on the financial sector, on capital markets, and so this is what we're kind of going to show here. So here we have the S&P 500, and then we have tax receipts. And we can see that every time the S&P 500 sells off here in 2008, we can see tax receipts plummet, right? Tax receipts went from 2.6 trillion to, at the height of the GFC, only 2 trillion. So we lost like 500, 600 billion dollars that one year because of the stock market declining. And the same thing is true with the dot-com bubble. I would argue financialization really started to kind of take hold of the U.S. economy in the 80s. It's hard to pinpoint exactly when all this kind of started, but that's when globalization really kind of took off, and you can note a number of things kind of started to change in the 80s. Certainly, though, by the 90s, and we can see the bear market in 2022 for the S&P 500. We can see tax receipts fell, right? So the government has become reliant on the the nominal US dollar return of financial assets like the S&P 500 for as a proxy, as a way to represent financial assets. We're looking at the S&P. The government has become reliant on people making capital gains. Well, we know that when you look at all the US equity ownership in the US, 93% of US stocks are held by the top 10%. We talked about in the prior video that 50%, a record 50% of consumer spending is done by the top 10%. Well, it's even worse when you look at asset ownership. The top 10% own a hugely disproportionate amount of the assets. And so basically what we're getting at here, the government has become reliant on capital gains tax, meaning financial assets have a nominal return, right? The people assume a capital gain, they pay tax on that capital gain. Well, we know that the people that are taking capital gains and in the stock market, in financial assets, are the top 10%. So we've kind of created this incentive for the government where they are incentivized because capital gains tax drives overall revenue for the government. And there's a great paper that I will try to find and link in the description if people want to dig into it more. But the Tax Foundation actually admits this. This paper is a couple years old, but they said capital gains tax is like thank goodness for capital gains tax because it is driving our revenue. And in fact, capital gains tax as a share of overall revenue hit a record in 2021 or 2022. It's in the paper, so take a look at that if you're interested. But the point here, the government is incentivized for the richest of the rich to do well, for their financial assets to go up, because then they take a capital gain and they pay tax on that capital gain, and that is the primary driver of revenue growth for the government. Okay, so one of the ways to visualize this particular dynamic is to take the S&P 500 and divide it by the average hourly wage. What this shows is the degree, remember with a relative chart, what you're looking at is the rate of performance relative to each other. So the S&P is the numerator. As this white line goes up, average hourly wage might be going up, but the S&P is going up faster, right? When the white line goes up, the numerator is increasing faster than the denominator. They both could be increasing, but this represents the numerator growing faster at a faster rate than the denominator. When it is going down, it indicates the denominator is growing at a faster rate than the numerator. So we can see after .com, which we thought 100 hours for one share of the S&P 500, we thought that was crazy at the height of the .com bubble. Well, now following the burst of the dot-com bubble, because the S&P fell so much and US wages didn't really fall that much, this came down, and it came down to a much more reasonable 50 hours of work for one unit of the S&P 500. If you look in the 60s and 70s, when like people my parents' age were being a young adult entering the workforce, trying to save money, you only had to work about 20, 30 hours of work to buy one share of the S&P 500. Now, however, you need to work 198 hours at the average job to buy one share of the S&P 500. We can see since the height of the GFC, the S&P 500 has increased 394% faster than the average hourly wage. Since 2000, so the past 25 years, the S&P 500 has grown 93% faster than the average hourly wage. Since 1990, the S&P has grown 488% faster than the average hourly wage. And if you go back to 1980, the S&P has grown 1,000% faster, 1,045% faster than the average hourly wage. Okay, so to wrap up here, here is, I think, really the story. So here we have GDP divided by the M2 money supply. Again, remember what we just talked about with relative charts. As this white line is going up, that is indicating GDP is growing faster than the money supply. Well, you can argue that we peaked out at the China shock in early 2000, right, which was when the peak really kind of occurred. But here's 2007, 2006, 2007. We can see GDP divided by M2. This gives you a good idea of like real GDP. Are we just printing money to get GDP? Because remember, if we print $10 trillion, we will get $10 trillion of GDP. Government spending is a huge portion of GDP. So what this white line is showing is, are we getting real GDP, real actual growth, or are we getting fake money printed driven growth? And what we can see is that, technically the peak was 2000, but you can see 2006, 2007, it was still higher than this period of time in the 70s, 60s, 70s, 80s, and 90s, heading into the GFC. And then what has happened since? It has just absolutely fallen off a cliff. Looks very similar to total loans and leases divided by M2, meaning the private bank stepped away and the government filled the void. Another way to think about this is, again, the real personal income, the real purchasing power of a year's worth of income. And the way you do that, you take personal income divided by the M2 money supply. We can see that the average American was actually benefiting from the 60s into the early 2000s. Their personal income would buy them more stuff. The purchasing power actually increased. Well, what has it been doing since 2000 and definitely since the GFC? It has been plummeting. And the same goes for velocity of money. Velocity is just what it sounds like. This is the degree to which monetary units are changing hands in the real economy. And sure enough, it basically tracks this real personal income. And again, all of this indicates that something broke in the real economy, and we just have this kind of illusion, this facade, this fake thing where financial assets going up and to the right to drive capital gains tax revenue and make the rich richer. Okay, that's great. Ever larger deficits to indebt the youth of the country into even more insurmountable debt. Okay, that's another way we're filling the gap. It's like, it's pretty mind-blowing. I'll just say that. And then at the bottom here, we have the S&P 500 divided by gold. And again, you can argue the peak happened in 2000, which ironically is right around when real GDP and real personal income peaked. But again, just look at the past history since 2008 or heading into 2008. If you had bought the S&P 500 right before the GFC started in September, October of 2007, you are actually down. Your return is negative in real terms. Because remember, gold is a good proxy over many years, over decades. It is a good proxy measuring stick of the amount of debasement. We can also see that with the white and the red line, which are indicating we are just printing ever more money, running ever larger deficits, printing, trying to stimulate fake GDP, and getting very little actual return. So to finish up here, I'd mentioned the three things that kind of stepped in to fill the void. Government debt to GDP in white, we can see that. Here I will zoom into, or I will mark 2008 with a vertical line here. We can see that corporate profits relative to GDP, so corporate profits divided by GDP, we have relied on corporations making ever more money. Again, GDP and corporate profits can both increase, but when this line goes up, this red line goes up, corporate profits are growing faster than GDP. Government debt is growing faster than GDP. We established the money supply is growing faster than GDP. Well, government debt is also growing faster than GDP. In fact, since 2008, like we had mentioned, government debt to GDP doubled. And then finally, S&P 500 relative to GDP. All of these are using the same denominator. And what they all three of them show is that all three of these things, government debt, corporate profits, and financial assets, that is what has been propping up our market, our economy. As you can see, the real economy, velocity of real monetary units in the real economy, or the real purchasing power of the incomes of Americans have been declining certainly since 2008, arguably going back to 2000 and the China shock. And something had to step in to fill the void. Well, we see that it's financial assets, corporate profits, and government debt. Those are what are growing faster than GDP. Now, remember, GDP has been growing since 2008. What this indicates is government debt, corporate profits, and S&P financial assets have been growing faster than the overall economy, right? So this is what we've turned the modern day U.S. economy into. I would just finish up again with this chart here of real personal income and the trend and how we diverged from it and never were able to catch back up. $58,000 per year per worker. Something happened in 2008, and ever since, in my opinion, I will also link to the other video I did on this. Ever since then, the average American has been getting absolutely decimated living through the silent depression. So probably not super uplifting, but at least hopefully this was educational, a good, part two conclusion to the video. The modern day U.S. economy is nothing at all like the economy we had in the 50s or 60s or 70s or 80s or 90s. We have this really bizarre thing that we've created. We mentioned the consumer spending being driven by the top 10%, half of consumer spending being driven by the top 10%. Wealth inequality is actually now worse than it was in the Gilded Age, which was so bad. The wealth inequality was so bad in the Gilded Age, we named an entire era of U.S. history after it. Well, wealth inequality today is even worse. We see the consequence, which is rising populism. Just as I've been predicting for as long as I've had this channel, we are starting to see that populism start to rise on both sides of the political spectrum. I expect that to continue. These are some big issues, and they cause real societal harm, real societal damage. We know polarization is at an all-time high. You create conditions like this where you impoverish tens of millions of people, you kill the American dream, you default on the social contract, things get bad. And I think that is kind of what we're seeing in the modern day U.S. In society today in the U.S. So anyways, hopefully that was at least educational. I know probably not the most uplifting. And I will catch you on the next one.